Hello, I'm Jared Nelson, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. One of the biggest macro factors this year is about to come into play. It is the $1 trillion infrastructure bill, also known as the Infrastructure Investment and Jobs Act 2021. This once-in-a-generation bill will cover important areas of U.S. infrastructure development, including bridges, highways, airports, clean energy, waterworks, electric vehicle charging, and broadband. It aims to reverse decades of underinvestment in America's infrastructure. The White House predicts this bipartisan agreement will grow the economy and enhance America's competitiveness. As the vote for this bill approaches, investors are assuming this act will eventually be voted through Congress. On this assumption, investors are placing bets already, with investment capital heading into U.S. infrastructure stocks. Have a look at the First Trust Smart Grid Infrastructure ETF, with ticker GRID. This fund tracks a basket of stocks exposed to grid-related infrastructure, and its prices have been soaring in recent days. Another infrastructure ETF is the Global X U.S. Infrastructure Development, which focuses on industrials and materials sectors. Like Grid, this $4 billion fund is on a roll. The fund is trading near its all-time highs and looks like it is about to break to the upside. Another choice for investors is the iShares U.S. Infrastructure, although it is smaller with $650 million under management. This ETF is weighted towards utility stocks like water. Chart-wise, the fund remains long-term bullish. Curiously, apart from infrastructure, the thick bill covers part of the digital asset market. In particular, the bill requires crypto stakeholders to report transactions to the Internal Revenue Service. The intention of this clause is clear: to raise money for the government based on crypto transactions. But the question of who should report to the IRS is not. Senator Pat Toomey cautioned that Congress should not rush forward with this hastily designed tax reporting regime for cryptocurrency, especially without a full understanding of the consequences. Amendments to clarify the original definition of a crypto broker were being debated fiercely last week. On one hand, we have the Wyden-Loomis-Toomey Amendment that excludes validators, miners, or sellers of software and hardware which do not maintain customer details. Another competing amendment by Warner-Sinema-Portman excludes proof-of-work validators, but not the proof-of-stake ones. As the latter amendment treats the two systems differently, it will drive a huge wedge between two major crypto systems and splinter the market. Understandably, this amendment is causing a furor in the crypto community. Most crypto stakeholders, including the Bitcoin Association, support the former amendment. Anyway, that's the background development in the crypto market. Mundane, we know, but no less important. Of course, the more interesting part is Bitcoin's price action. The question everyone is asking these days is this: has Bitcoin completed its multi-month consolidation? Having rebounded sharply from $29,000 to $41,000, prices were on the run upwards again last weekend, and it hit a high of $44,500. The strength of this rebound is so powerful that speculative capital are pouring into crypto stocks. Riot Blockchain has rallied almost 50% from its July lows, while Mara Patent is up almost 62%. Bitfarm, which mined 391 bitcoins in July alone, doubled its share price in just 13 trading sessions. The very first thing when a bull market starts is that short sellers are forced to cover. BitDigital, which dropped for 13 consecutive weeks, rocketed 350% in 10 days. Two other things should be mentioned about these crypto stocks. The first is that mining difficulty has dropped significantly since Chinese miners were forced out of China. Profitability of these firms is near all-time highs, with margins at 60 to 80%. Secondly, some ETFs are starting to accumulate these miners and Coinbase. For example, Millennium Capital is approved in Europe to start a fund buying a basket of crypto miners. Others may open up soon. Fidelity, the multi-trillion fund manager, liked Mara so much that it bought 7.4% of its outstanding shares. Some may argue that the sector rally is now too overbought to chase. We somewhat concur. Waiting for a retracement to buy may be a better option, instead of chasing the sector higher. The problem with this wait-and-see approach is prices may run significantly higher from here. Remember to position size bets intelligently, as this is a hugely volatile sector. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.